Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Roy Bhavi. Roy is a serial entrepreneur. He's a real estate developer with a passion for helping small businesses succeed. As the founder and principal of FlexSpace Business Parks, he is dedicated to building high-quality, multi-tenant, light industrial flex space business parks that meet the needs of growing businesses. He is frequently a speaker, a writer, and on the topic of flex space, and he is committed to educating entrepreneurs about this type of space and its benefits. So, Roy, thank you so much for being on The Wealth Flow. I'm looking forward to this.
I'm glad to be here. Very excited to share whatever I know about this business, about this asset type with your listeners, and always happy to be on a platform such as yours.
Great. Well, why don't we do this? Why don't we start maybe with where you grew up and, what eventually led you to this real estate venture that you're in?
Sure. So my journey starts in Mumbai, India. That's where I was born and brought up. I spent my formative years there. I went to the University of Mumbai there. I got a degree in computer engineering there. And I started on my first career as a computer programmer. And that's what brought me to the United States back in 2005. And after that, after a few years of being in the technology sector, I decided to change career tracks. I went to business school at the University of Chicago, and I got a degree with concentrations in entrepreneurship, marketing, and general management. Thereafter, I was very fortunate to join a late-stage telecom startup based out of Denver. It was actually founded by an alumni of my business school. So I had the great fortune of being able to join that team as an executive. And I worked with that organization for a few years, and we went public after a few years, and we all had great financial outcomes as a result of that. That was when I decided, I wanted to do something more substantial with my career, with my professional life, and I wanted to find more purpose and meaning with it. And I was in the midst of finding that mission, that goal for myself. That's when I started really dabbling in real estate for the first time. I went ahead and made a couple of investments. Not a couple of investments, a few investments in different asset types. I wasn't very sure which asset types were going to work out best. So, I just went with, okay, let's put some money in everything and let's see what sticks. And that's where I got my first exposure to flex space. I made a couple of investments with other in the projects of other developers, and maybe it was a function of the market, or maybe it was a function of the developers. Those investments gave me some very outsized returns. And that's what really got my attention. And I decided if I was going to dabble in real estate, I want to do something substantial. That was the asset type that I was going to focus on. While I was trying to figure out, what strategy I was going to go with to be in real estate, I also helped my wife, who's a dentist, set up her own practice, get it to be a growth engine, standing on her own feet. And, it was very helpful for her, for me to have that business acumen and help her out on the business side of the business. A lot of people think one of the struggles a lot of doctors, dentists have is, they are trained to be doctors, but they're asked to operate a business. And I frequently come across a lot of physicians, doctors, who are struggling, not because they're not the great doctors, but they just don't have any kind of formal training in managing a business. In my wife's case, she was fortunate that I was by her side, and so she still runs that business, and it's doing great. That gave me some exposure to running a small business and seeing what are some of the classical problems of small businesses. Whether it's cash flow, finding leases and places, and things like that. So that's been my journey. Now, in 2022, I went in full on with the real estate space, and I started a development company, Flex Space Business Parks, with a sole focus on developing flex space business parks. That's what I do for bread and butter now.
Okay.
So that's been my journey so far.
That's awesome. And so, it sounds like maybe, the work that you did with your wife helped out as far as just kind of, you learned some of the struggles of trying to find spaces to place businesses, that kind of thing. So I think that was probably a good background. And that's fantastic that you had the opportunity to be part of that company when it went public. So that's awesome.
Absolutely. That experience, and also my experience at the telecom startup. I was a sales director there, and a lot of my clients, my customers, were small to mid-sized businesses, and we're just working with them, trying to understand their problems. It gave me a lot of insight on how what are the challenges facing small businesses. So that's when I decided, I need to do something with my real estate career where I focus on not only providing spaces for these businesses, but also what else can I do to help them elevate their game plan.
Yeah. Well, for the audience, Roy, do you mind just sharing what is a flex space? What's considered a flex space?
Yes, absolutely. So a flex space is actually a very modern naming invention. This asset type has actually been around for a while. The traditional name, most people will identify it with, they are called office warehouses. So flex space or office warehouse is any single story building which is a combination of a warehouse and an office space. Now, typically, people think about different asset classes, such as, we have your retail, you have your multifamily, you have single family. So flex space, a good definition of it would be classifying it as retail industrial. It's any space where, which is customized or appealing to a lot of the trades businesses, such as your blue collar workers, or businesses such as your electricians, plumbers, HVAC guys, your landscaping companies, people who make cabinets, furniture, those kind of businesses. So if you think about these businesses, what they require for their place of operation is they need a large open space, basically a warehouse, where they can do their business operations, whatever they're assembling or creating or storing. And in addition, they need a small space, a small office space, or some kind of a retail front where, maybe they have one or two employees doing the front end work, the front office work to house them. So that's what a flex space is designed to accommodate and appeal to. Now, one distinguishing feature of these office warehouses is that they will have a loading dock or a warehouse door, a tall warehouse door, usually a 14 to 16 foot warehouse door, which is located right next to your man door where the office space is located. Now, the reason for that is the warehouse door is important. The bay door, as we call them, is important, is that's the way the customer, the client, the tenant in this case, is able to bring in his deliveries or maybe his box truck or maybe his big equipment or his machinery into that warehouse space. That is a very key distinction of these flex spaces. And they have evolved a lot nowadays, or rather they become more appealing to a lot of businesses just because of the versatility of what a business can do with that combination of office and warehouse space. Traditionally they have appealed to these tradespeople, as I mentioned, these plumbers, electricians, but now I see businesses even like florists or boxing gyms also getting attracted to this space. So its appeal has widened. It was also always very versatile, but now a lot more businesses are finding it more and more convenient and cheaper, frankly, to be located in a flex space business park.
Okay. And so when you had mentioned kind of before deciding on this particular asset class that you'd invested in some other maybe asset classes, what did you invest in, and what kind of was attractive about the flex space space?
Yeah, absolutely. So as I said, like my strategy was like I did not know much about real estate then, and so I said, okay, I'm going to invest in every single asset class which is out there. So I did single family, I did multifamily, I did industrial, the flex, I did commercial investments. So all of these were small investments where I was not the sponsor. I was mostly like either a very minority investor or a limited partner. So the intention was to just make a small investment and get to know how that asset is performing and what are the key drivers of that asset class. And what really made me um, drawn to flex space was two things. One, as I said, like the two investments I made in the projects, flex space projects, those gave me some very outsized returns in a very small period of time. That was number one. And number two, what I also realized was how conducive this asset class was for a long-term hold strategy. The reason it's a very good long-term hold strategy is because unlike your single family or multifamily, you really don't have a lot of friction when it comes to your tenants. People who, I'm sure your listeners who hold single family or multifamily or any kind of residential properties, one complaint I always hear from those investors is, oh my God, I don't know when I'm going to get a call from this tenant, and and what it could be and what my expense is going to be. So that's always a common concern when you're investing in residential. Now, contrast that to anything commercial, where you're now dealing with a business and the terms of the engagement are more well defined, and their tenant, which is a business, is very more likely to take care of its own problems rather than calling the landlord for every single thing because of a thing called triple net charges, right? So in commercial and industrial, the lease this lease is structured in a way where there is a base rent, and the tenant is responsible for your taxes, your insurance, and the common area maintenance charges. And if anything breaks or anything goes down in their location, they are themselves capable of going and finding somebody, getting it fixed, and it's their responsibility, frankly, according to the lease. So, being a landlord to a commercial tenant or an industrial tenant is a lot less frictionless. And that was my experience with the investments I had made in these flex-based businesses. So because of that reason, I thought this is going to be a great long-term build, lease, and hold strategy in type of investment.
Yeah, that makes a lot of sense. And what about as far as where these investments are, or where are you currently investing in this? We were talking a little bit before the show, and we're both in Texas, you in Dallas, me in San Antonio. Are you investing in the Dallas area, or where are the investments going?
So the investments I had previously made were both in the Houston market.
Okay.
And then since then, but I am a Dallas resident, and that was one thing I was not too sure about. Investing in a market where I don't reside. Having that local knowledge is always beneficial. Real estate is so much about being local and having that specialized knowledge. And so when it came to actually doing my own development, I made a very conscious decision that I wanted to build my first project in the Dallas-Fort Worth market. So as of right now, we are building an 85,000 square feet business park in Rockwall, Texas, which is an eastern suburb of Dallas.
Okay, that's great. That's really going to be neat. And so how many tenants would typically lease from you with 85? You said it was 85,000 square feet?
Yes. So this business park, if every single tenant occupied the smallest possible unit, we would have about 50 tenants. Now, typically these flex space units range in size from 1,400 square feet to about 2,000 square feet. That seems to be the sweet spot where it's enough space for a small mid-sized business to do their business operations and also have one or two employees doing the front office work. Anything bigger than that, yes, there are businesses who require more space, up to 5,000 square feet, but I rarely see businesses requiring less than that, less than 1,500 square feet. So in this Rockwall Flex Space Center, that's the business park we are building right now, the unit sizes range from 1,450 square feet to 1,780 square feet.
Okay. And so that's going in advance, and you've got that all planned out. It's going to be built out that way. If there's a particular tenant that says, Roy, is there any chance that we could have double this space? Is there availability to be able to take a wall down and combine the two spaces, or what does that typically
Yes,
look like?
absolutely. And that's one of the reasons we call it a flex space, because it's very flexible.
Yeah.
And so typically the way it works out is we design the building so that every unit is that small size, that 1,500 to 2,000 square feet. But when we are in the finishing stages of development, or rather 3 to 6 months before construction is complete, we go start pre-leasing these units. And you almost always have this situation that you just described, that there comes along a tenant, a business who says, 1,500 is too small for me, I need 3,000 square feet, I need 5,000 square feet. And in those cases, what we do is we give them 3 contiguous adjacent units, and we don't put up the demising walls, and that way they end up having a bigger space. Now, from a leasing standpoint, from an economic standpoint, it is good when you're doing your first generation tenants to be able to do that, because I'm getting 3 tenants and who's taking up 4,500 square feet in one contract, right? is good from a first generation perspective. But if that tenant decides to not renew the lease in 3 years or 5 years, now we have this large open space, which becomes kind of a liability later on. Leasing bigger spaces is actually more difficult, or takes longer. Not more difficult, it just takes longer, and the return on the lease is lower. I would rather have, when that tenant leaves, the first generation tenant leaves, I'd rather have 3 units than one big open space, which is a combination of 3 units.
Yeah, for sure. Makes sense. How big is the office space usually on these?
The office space is usually, on a percentage basis, is between 10 to 15%. So on a typical 1,500 square feet unit, your office space might be about 150 to 200 square feet, and then you'll have one unisex bathroom as well. May or may not have a closet to keep your supplies, or your router and equipment such as.
Okay. And so tell me about this project that you're in the middle of. How far down the road are you with it? What stage are you in, and how's it going along so far?
So this project, we got started in January of last year, and we ended up closing on the land in June of last year. So it's been precisely a year since we procured the land. And since then, we have been going through the entitlement with the city. We have had some challenges with that. In particular, one particular challenge with this project was that it's very adjacent to a municipal airport, which meant there was one more body that we had to get our approvals from, which is the FAA. And that was kind of a black box, and it took a few months to get our plans cleared with the FAA. So since then, I think we're about 80% complete with our entitlement, and the projection is for us to begin breaking ground in late summer this year. And with that respect, we have been doing fundraising and getting the capital stack together for the project.
Makes sense. And so tell me a little bit about the design of these. Is this a rectangular piece of property? And if so, what is do you have, is it all on one side as far as the building, or are there two buildings on two sides? I've seen a lot of them that kind of vary. Some of them horseshoe shape almost, where you got a big parking lot in the middle. Some, if they have boarding doors, or not boarding doors, but whatever you referred to them as, kind of coming around the back.
Doors, yeah. So in my case, the property is rectangular, and the way we planned the site for the project, for the business park, was we went with 7 buildings. So we have 7 buildings. They're actually of almost equal. They're not of equal sizes. And the reason we went with that is because this is going to be a phased project. We're doing it in at least 2 phases. In phase 1, we're going to build out 3 of the 7 buildings for a total of 37,000 square feet. And the phase 2 might be all 4 buildings at once, or maybe we might break it into smaller phases, depending on market conditions. Then now you're right. When it comes to the layout of the site, you always want to design them in a way where it appears that traffic flows in a U pattern, like a loop through your property. Now, usually you want 2 entrances, an exit and an entrance to the property. That can sometimes be a challenge, depending on how wide your frontage is on the access road. And but in my case, I was able to get a variance with the city, and get two entrances to the property. And you want them to be free flowing. The typical thing, what is very unique about FlexSpace is the businesses who reside in these properties. They don't need any kind of exposure. What I mean by exposure is they don't need any kind of frontage. They don't need to be visible to the public. because these are businesses where the business goes to the customer site to provide their service or product. It's very rare and very atypical for the customer to come to the location. And so they don't need to be in a very high density neighborhoods. Um, all they need is great access to the major neighborhoods or major population centers, but they could be out on the city's boundaries or even outside city boundaries. And that makes it worthwhile for us to design the site in a way where the parking requirements are not as great as you would need to provide in typical retail, right? When it comes to flex properties, the parking ratio usually is anywhere between one parking spot for every 750 square feet or 1,000 square feet. So you're able to have very dense um, uh, net leasable area on your property. To give you a sense of this project, so this project, the land itself was about 6.2 acres, but we are able to build about 85,000 square feet on that, which is about the more than 30% of land coverage, which is high compared to your other commercial asset types, compared to retail or even pure commercial.
Yeah, you just don't have as many of the customers going there. What about signage? Do you have any signage at the front of the property showing which businesses are in there, or is that not something
I
that's?
would love to have that. But most municipalities, they will have restrictions on how much signage you can put up. And I think so. In this case, in Rockwall, I can't put up a big pylon which lists every single business which is out there. You probably only can get one sign which says Rockwall Flex Space Center, and then every business gets their own signage above their business suite. That's about it. That's the extent of it.
Okay. Makes sense. Well, it's a great spot to be putting one for sure. It seems like there's always, a lot of, the population kind of seems to be heading out that direction, as Dallas fills up. And, it seems, what drove you to choose that particular piece of property to put this on?
It's always the same. I have a few basic metrics that I look for when I'm choosing or looking for land. First and foremost is size of towns or the cities. My benchmark is, a town needs to be having at least 30,000 people in it. That's my number one metric. Number two is it needs to be growing at a good enough pace. If US population growing at 2% a year, I need this town or city to be growing at double of that. That means it's in a growth path. That's where people are moving to. That's what I want to see. Third is incomes. Look at what is the average median household income. What are the prices of the houses themselves? I want to build these business parks in places which are very close to your HOA kind of neighborhoods. The reason for that is you got to think about it in a little backward sense. So if I'm thinking, who are my tenants? My tenants are these tradesmen who are providing services to homeowners. And so if the vicinity where I'm building my business park has a lot of new homes coming up, 1,000, 2,000 homes coming up, by the time I finish my development and I start leasing my project, these homes would have gone up, and these homeowners are now in need of these services. They want to get rid of the contractor grade paint, for example, and they need a painter. Now, the painter who is going to come and provide that service, he might get more references or more customers in that neighborhood, in the vicinity. So he thinks, all right, I'm getting a lot of business in this particular area, so I need to either move my location, or I need to buy a space or open a new branch or some other kind of. They need to be in the business, in the vicinity, so they can service all these homes. And that's when they're going to start looking and maybe come across and start leasing from me one of the units from my business space. So when you're looking for land, my intention is to find in my market, in the larger submarket, what is the growth path, where are the new homes going up, and then find a good enough property for a fair enough price. And that's how I go about picking land for myself.
Okay. And what about so do you have the site plans and everything? Does Rockwall require spots for, say, rainwater runoff and all that? What was the process like?
It's not. Yes, Rockwall does need. You have to. So my project, we have a large detention pond, and that's not only a requirement from Rockwall. I think every municipality out there nowadays is requiring detention of some kind, and so that takes away land area that you could build on, but it's the same for everybody. I'm not aware of any locality, any municipality in the Dallas Fort Worth area where detention is not a requirement anymore. The one way you can get away from doing detention is if you were to build in the county land, on the county land. That's where you are like having very few restrictions on what you can build, and you probably get to build it cheaper because land itself is cheaper, and the requirements to build your building requirements are also a little more lenient. But you also have to weigh that against what kind of lease rates you can command, right? Like when you're located out in the county, what businesses would want to come and lease from you? So your tenant pool itself becomes a lot more shallower and it's a little more difficult to lease. In my experience, the trade-off between the cost of building being higher to build in the city, you get a better return on investment because your lease rates are also higher when you're in the city.
Tell me a little about the size of this project. So, cost-wise, what how much are you going to need to be raising for it, and what is what are some of the expected returns, that kind of thing that you're going to have for your?
Yes, so I'll just share high level numbers. So the total project in our estimate right now is going to cost about $11.5 million. That's the total extent of the complete project, not just phase one. And going by current cap rates and the lease rates that we're expecting, I think this project in 4 years, when it's fully leased and stabilized, is going to the cap rate is going to be around 6.5, maybe 7 cap rate. At that point, it will probably be valued at maybe anywhere between $18 to $20 million.
And what's the plan at that point? Are you looking to do? Is that, did you say that's about a 4-year period?
Usually, 3 years is more likely. If things go well, 3 years is where you probably would be done, stabilized, and have all your first generation tenants in. But in the current macro environment, there's a little more uncertainty. And so I anticipate the leasing to be a little slower. And so I'm thinking maybe 4 years instead of the 3 years.
Okay. And then at that point, after the 3 to 4 years, is the exit strategy to sell at that point to another investor?
Absolutely. So that's the intention. It of course is driven by market conditions. If the lease rate, if your cap rates are hovering around 8%, I think maybe that might be a better choice to just hold on for the cash flow. These assets, as I said, when it comes to maintaining or holding these projects, these are not very labor intensive and pretty cheap to operate them. And so holding for cash flow is also a great strategy if the market is not conducive to doing a sale. But since this project is at a scale of close to 100,000 square feet, it is going to be in the sweet spot where it attracts a lot of investment buyers, even smaller private equity firms.
Yeah. Okay. I was thinking it's kind of up in that spot where that
Yes.
would make sense.
Typically, what we tend to see is anything less than 50,000 square feet, you probably are looking at a high net worth individual kind of buyer, maybe an investment group of 2 or 3 people who are going to buy that asset. Once you start hitting about 70,000 square feet and above, even 70,000 to 200 square feet, that's where it's usually going to be an investment firm that's going to be the buyer.
Okay. And with this, just along the project itself, were there have you ran into any surprises, any things that you maybe didn't anticipate, and how did you overcome those?
Development is a very risky game because there's always surprises. uh, so as I earlier mentioned, one of the big surprises was how long it took us to get our approvals with the FAA and how involved the paperwork was with them. Yes, we knew that was going to be a hurdle for us when we put the land under contract, but nobody had any clue that it was going to take a few months, close to 6 months to get all the approvals in place. So to give an example, what happened is we got our site plan, and before the city will even approve the site plan, you have to go to the FAA and get them to say yes to those building heights and the building locations. Now, we were not aware of that. And so we went to the city, and the city actually then even looked at it and then told us, hey, we can't even touch this till you actually go to the FAA. So we made our first submission to the FAA, and every cycle with them is at least 6 to 8 weeks. So after our first submission, they came back to us and they said, no, this project is a no-go. We do not like it because your buildings are too high. And they were too high by about 2 or 3 feet. And so with that said, we had to go back to the drawing board and address those comments. And the way we solved that was we moved the location of the buildings a little bit to the east and outside the flight path, and we reduced the height of a few buildings by about 2 or 3 feet. It didn't actually affect commercially the viability of the product itself. Our architects were clever enough to build those heights that the tenants are going to require, but at the same time meet what the FAA was requesting of us. So once we did our second submission, they were happier with that. But again, every time you have to deal with them, it's at least a 6 to 8 weeks lag. And so this back and forth with them cost about 4 or 5 months. The second one was, is this hasn't happened to me in my career yet, but this was the first time in this project. Is the coordination which is required when you are the first in and around building something. So I have neighbors on my west, I have neighbors on my east, and it's all agricultural land which is being developed for the first time. So I'm the first one building right now. Everybody else is just sitting on the land. When we went to the civil plans with the city, there's a whole bunch of stuff that I'm required to do in order to accommodate future needs of my neighbors. I have to put in a public sewer which they can access. I have to build a public storm drain which is going to drain their property, and all this is at cost to me, but I don't get reimbursed for that. So this was a new one. I did not anticipate that. But with development, as I said, like there's always surprises around the corner, and you got to be able to deal with it as they come along.
For sure. Yeah, I could see that. I guess with so are you when you say you're having to build those the public sewer, the storm drain, and all this, are you having to bring it in from beyond your property up to the property to connect to whatever the existing wherever the existing city utilities are?
That's right. That's right. And we are actually having a bigger challenge because the public sewer, which is supposed to come onto my property, is on the other side of a railroad. And so we're actually having to bring that public sewer, drill under the railroad, and then pass through my neighbor's property and then come onto my property. So it's actually requiring us to coordinate with the railroad company and a couple of neighbors to make that happen. Again, it was not a surprise. This is all that we look for when we do our due diligence once the property is under contract. And so it's not a surprise, but that yes, you have to deal with your neighbors, you have to get some concessions, you have to work with them on that, and that can take an obscene amount of time, depending on whom you interact with.
Yeah, for sure, for sure. Wow. Yeah, it sounds. Well, you've made it as far as you have, so you're getting close. That's
yes,
it's
yes.
one of those. Well, tell me a little bit about rates and where you think from a rental standpoint. Obviously, the market can change some, but these are triple net. Maybe even dive a little bit into the triple net. Explain that for the audience. I know we've talked a little bit about some other triple net on the show, but it's good to just kind of be a reminder as to what that is compared to just like a gross rent.
So a gross rent, I think a good analogy would be when you compare to an apartment, right? When you have an apartment, the tenant is paying a base rent, and they are not paying for the insurance of the total property. They are not paying for taxes for the whole property. They just get a fixed bill. They say, okay, my rent for my 2-bedroom is $2,000 a month, and I'll pay that, and then I'll pay for my own utilities, right? That's the deal. That is, in a commercial world, that would be considered a gross lease, where apart from that one single check, the $2,000 check, I'm only responsible for my own utilities and nothing else. I'm not going to write a separate check for maintenance of the pool, for example, or the landscaping, right? So that's in a commercial world, that's considered a gross lease. But in the commercial world, triple net leases are more commonplace. So what does it mean by triple net? Triple net means is NNN, the 3 N's. The first one is your taxes. So what will happen is whatever taxes are assessed for the total project, for the total property, they will be subdivided into all the tenants who are occupying that property, and they are responsible for paying those property taxes through the landlord. So you maybe have a property management company or the landlord themselves, but you will write a separate check at the end of the year for your share, for your pro rata share of the property taxes. In a similar way, you are also responsible for the insurance premium for the entire property. So whatever is your pro rata share of that, you're going to have to pay that to the landlord. And then last one, the third N, is your common area maintenance. So your landscaping or water for your electric lights in the property. So whatever the charge for the common area maintenance, you're going to get a separate charge for that. You're going to have to pay your pro rata share of that. So a triple net lease, in a flex space world would be, let's say you are occupying a unit which is 1,500 square feet, and your base rent for that is 2,000 square feet, $2,000. So every month you're going to write a check for $2,000. But at the end of the year, you're also going to get an assessment from your landlord or property management company saying, hey, your pro rata share for the triple net charges is, say, $4,000. So you're going to write at the end of the year, you're going to write a separate check for $4,000. So that's how triple net leases work.
Okay. Yeah, that's obviously nice for the landlord because then you have the ability to know that you're going to get the full amount of the rent that you're charging, and anything extra is really anything that normally would fluctuate for a landlord, the taxes, the
Right. And
maintenance.
actually, in today's world, like in the past 2 3 years, landlords who are on triple net leases, they have been fortunate because insurance premiums have just gone up so much. And if you're a landlord, at least you can breathe easy that it's the tenants who are actually responsible for that, and they're having to pitch in that extra 30 40% that you're now paying in insurance premiums. Um, so in that sense, it's good for the landlord. Of course, your tenants are going to resist to want to sign those leases. And especially if you are one of those small businesses, you probably don't understand how this works, and there's going to be some resistance. In the past, office warehouses, they have always have been on gross leases. So this transition to triple net leases is very recent. And so there are a lot of these tenants who will come to you and they'll say, what's a triple net lease? And so you'll have to do some education of that. But any new properties, any new projects that I have seen being built, they're all being leased on triple net basis nowadays.
Yeah, it does seem like everything seems to be going to that, or at least I've seen a lot where they're starting. Maybe they purchase an existing building, it happens to be gross lease, and then as the renewals come up, they're converting them to triple net. So
yes, there's a great
popular.
value opportunity going on right now in this office warehouse space. It's really hard to find them now, like the good ones. But that's a great value opportunity right there. You convert a gross lease to a triple net lease, and you immediately add a lot of dollars to your NOI.
Yeah, for sure. And now you're going to be tied up with this project here over obviously with the next 4 years, 3 to 4 years for getting it leased up. What beyond that, Roy? Tell me a little bit about where you see things going over the next 5-10 years for you and for your company.
So our intention is to start a new project, or at least begin a new project every year. And so this counts, the Rockwall Flex Space Center counts as our project for 2023, because that's when we procured the land for that. And so right now we are really in an active search for procuring land for our next project, the 2024 project. And so I'm always out there visiting sites, looking for our next piece of land to do a project. And eventually we'll probably end up with a situation where we have a portfolio of maybe 3, 5, 8, 10, I don't know how many, but where we have these big flex space business parks in our portfolio of closer almost $1 million square feet in net leasable area, and that will make probably a very good portfolio sale.
For sure. Yeah. I was thinking if you were going to kind of have the opportunity to be able to combine all those for one large exit, which would be nice. Cool.
Yes. And that depends on whether this asset types continues to overperform compared to other asset classes. My market is changing dynamically, and there's a lot of developers in the space now. It was a very niche asset maybe 5 years ago, but now everybody understands this, and it's like the cat is out of the bag right now. And so it's becoming more and more harder to locate land and build this asset type in areas that I would want to build it in.
No, I've seen it as well. I've seen even multifamily is kind of going through a rough patch right now, and a lot of folks that have been in that are looking for other opportunities. It seems some of them are finding a spot there, and the kind of smaller industrial, and so yeah. But I mean, it's a great asset class, and as things continue to grow, it seems like it will continue to have the demand that'll be necessary. So
yeah, I think so too. I think what gives me confidence that this asset class is going to be around and it's going to continue to overperform is because the appeal to the tenants. Now you're tapping a very wider pool of tenants. As I was earlier mentioning, this used to be a product which was only appealing to your tradespeople, but now it's a little more mainstream. I have seen florists in these places now. I've even seen a dentist in one of these places. I've seen people doing kickboxing and a taekwondo and all these. Now these were traditionally businesses which would go to your proper retail strip mall, in the neighborhood retail. But now they are opening their eyes and saying, hey, I can be in this location, I get the same amount of space, even more, and it costs me 20%, 30% less to be there. So why not? And once people businesses start doing that migration, the demand for this asset class is going to be higher. And that's the hope that I have. That's the optimism that I have, why this asset class is going to continue to overperform in the next decade.
Yeah, I think so too. That's a great point. Well, Roy, this has been really great. Tell us how folks can find out more about you if they want to kind of see what you have going on with the future projects, if they want to possibly invest in this one. How do they reach you?
They can go to my website, which is flexspacebusinessparks.com. Or if you do a Google search or just say FlexSpace Business Parks, I'm the number one listing on Google. They can always go to my LinkedIn profile, and reach out to me directly from there. So right now, as I said, I'm doing fundraising for this project and for our next one. And we have opportunities for equity investors, as well as convertible debt, which comes with fixed payments, but with the option of converting it to equity over the next year. So people who need consistent income, we have opportunities for them. And for people who want that big outsized return in 3 to 4 years, we have opportunities for them as well.
Okay, great. Yeah, so you got a couple different options on how to invest. That's fantastic. Well, this has been cool. I want to maybe shift to just 2 questions that I ask every guest. And one would be, what advice you would give somebody who's maybe just starting out in their investment journey?
If for people who are starting out their realist investment journey, I would say build a big enough capital stack. Now, this might sound contrary to a lot of people. If you have $20,000 to invest or $25,000 to invest, let's say, the conventional advice that I received when I was starting out was, okay, go buy a single family home, right? That's enough to do a down payment on a small home, go rent it out, right? What I would say is think about it in a different way. You want to play the big game for the big gains. And in order to play the big game, you got to have a big pile of money. So if you have $25,000, maybe hold on to it. Maybe keep it in liquid cash for now. Maybe invest in some, liquid investments. But wait till you have $100,000 or $200,000 to invest. Now we have a big pile of money. Now you can play and participate in the big game, which is development or doing value add. So that would be my advice to somebody starting out. Yes, I understand it's more riskier. You're putting more money at work. But if your goal is to make a lot of money, then you want to start with a big pile of money too.
Yeah, I love it. Love it. That's great. How about a book recommendation? Anything it doesn't have to be real estate related. It certainly can be, just something that's been impactful.
One of the books I recommend people is The Almanac of Naval Ravikant. He is a guy that has been an inspiration to me for the last decade. I follow him. I have followed him on Twitter for a long time. And that book is like a biopic on him. And the reason I like that is it's a book not only on not it's a book on life, because it talks he talks about things on how to build a good life. And it has chapters and areas: how to build wealth, how to look after your personal journey as a human, how to look after your relationships. So it's like a complete guide to being a great human being and a wealthy one at the same time. So it's a great place to read and get that holistic view on life.
Oh, that's great. Oh, great recommendation. Well, Roy, this has been really fun. I appreciate you being on the Wealth Flow, and I've enjoyed our time together. Thank you so much.
Thank you so much. I enjoyed my time and talking about flex space. I always get very excited talking about it and sharing what I know. And I always encourage people to reach out if you have any questions. If they are thinking of doing flex space for themselves, I'm happy to share what I know. I have been helped by others along my journey, and it's just my duty to pass along the same.
Awesome. Well, you did some of that here today, so fantastic. Thank you, Roy.
All right, Keith.
All right.
Thank you so much. You have a great day.
You too.
Bye.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.